What is up, everyone? Today we are going to be going over the second section of the technicals section in our mentorship. And in the first section, we covered the basics of a range, the 4 stages of the market, covered a few other things, our basic price map, and a little bit on psychology. But I again want to point out the psychology section and other sections aside from the technicals, such as the risk management section. Once they drop completely, as of right now, the first psychology video is out, and I'm dropping more very soon. I just want to make sure I structure everything right. They are going to be, whether you believe it or not, more important to your trading success than these technicals here, no matter how powerful these technicals are. I am going to essentially be outlining how to read every single market, how to compound your analysis, and how to read literally any single move that ever happens in every single market ever on any given time frame. That is what we are going to be doing. That is what I'm going to be teaching you, and it is very powerful stuff. But you need to understand, you must understand the other sections in this course because they are detrimental. They are crucial to your trading success. So just instead of watching only the technicals, then trading and losing a bunch of money, and then complaining that what I am saying is a scam or fake, even though it's very obviously not, especially if you go test any of the stuff I am showing you, watch the other content, understand it, take notes on it, and simply level up over time. So this section here, aside from that little rant, I'm going to be going over the starting kind of like how you go about top-down analysis and figure out exactly where you're at any given moment in time and price. So remember, to start, number one, we read a chart from left to right. That's the first thing I want to get very clear here. Now, this is how we go about top-down analysis, how we go about analysis in general. We should always understand exactly where we are this exact moment in price while using all past data since the market was, since the inception of whatever market it is you're looking at to define that. So first, left to right. Second, we start on the highest time frame applicable. You'll understand more on that later to come to these conclusions. So first off, we have gold here on the 6-month chart. Now, going all the way back here to 1834. Given how flat this is, and given that there are multiple ranges established, we can already start our process of narrowing down. So here, instead of going in and finding exactly what happened on the super small time frames, I can already tell you there were highs and lows printed within this range here on this higher time frame. Now you can see how price shot up, creating a new range. So we have low, let's just say there was a high here, a new high here being a higher high, a low, a higher low, and then ultimately this range was broken to the top side. That already has me under the assumption that price has broken to the top side within those two prior ranges. So I've already refined essentially 100 years, 130 years of data down to the moment price broke up here. Now, you can see as I continue left to right, it is literally just a process of defining the ranges. So here we have break to the top side, higher high established, come down, higher low established. Ultimately, notice this here, this range being broken to the top side, a new range here being formed, and a continuation to the top side. So, because current price is all the way over here, and I know that given context, we have been in this uptrend entire time after we broke up here to the top side, putting in this high. Mark that up right there. We have already refined to this point at least, given all prior data. Now, after price broke this high, we came down and we formed this low. Now, this is where things start to get interesting. We'll go more into actual top downs and combining your ranges, kind of compounding everything later on as we get more advanced with this, but I just want to show you the basics of it. We're going left to right, establishing ranges. Now, we're going to have two different things to look for. Up to now, we've only looked for these outside ranges to define the general area, but from this high to this low, understand that as price came up, we have yet to break above this high with momentum. Okay? So, we are now looking from this low to these wick highs. Notice there was no close above here, just wicks, aka rejections, aka liquidity, aka money. Now, as price comes up and forms this high, we can go down to the lower time frame and we can start to paint essentially a picture of how this price moved. Now, because the outside ranges have given us enough information to this current price, we can now go down and look at the inside ranges of that outside range. So here you can see we printed this low. Now, what was the high that caused this low? This high right here. Notice this move up before the move down, which had broken structure, giving us this close beneath it, to then move to the top side, then printing in a new high, testing back in, a new low, yet to break at that point, coming back in, testing into here, technically printing a higher low while still printing these equal highs. This here had ultimately led up to this top side break. Let me go down to the weekly time frame, to this top side break, where you notice from here, I'm essentially following the inside structure of this overall leg up. So I want you to understand that you are going to be looking at a range and then the sub-ranges within that, okay? This is the introduction to fractals in the market because, yes, every single move prints the exact same, but they print with moves inside of moves. So what does that mean? So let's say you have an uptrend within the 4 stages of the market. Okay? On a higher time frame, this uptrend will just look like this, just say a straight line. On a lower time frame, this uptrend contains all 4 stages of the market within it, within the sub-ranges of it. So take here from this low to this high, for example. Within that, on a lower time frame, this is what it will look like. Understand? It is fractals. There are moves within inside of moves, and all moves kind of follow the exact rules and criteria that we look for. The trick is understanding when to use which range. So we always start with our largest ranges, this straight line, which you could have said was here, to then come down here, giving us this range. So low, high, higher low, then continue that move up, or that straight line, that outside range structure. Now the inside structure within that, in this case, we just go back and we look at the low here and follow what happened before it was printed by this high, coming up here, boom, 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 boom. Let's go back to a daily chart, and you can start to see how fractals are starting to play out in here. Now notice, I don't want to get deep into it yet because I don't want to confuse you, but even the sub-ranges of this overall range, the sub-fractal trends, whatever you want to call them, are going to contain even smaller fractal ranges within them. Once you start to see this naturally occurring in price, you can already understand how the concepts with supply and demand, with fractals, with range, with everything we use, how powerful it can be. So, one of this video was and go down here. And we read a chart, from left to right. Now 2 is using the concepts from the first section. We have range. And what we are looking for is to use these overall ranges, aka already printed here, high, low, higher high, higher low, up until the point where we have this, the overall range not yet being broken, or a failure to break and then a reversal to the downside, in which case we look for the sub ranges. Okay, so these are the main 2 points that I want to get across in this video. We're going to be reading a chart from left to right, and then we have ranges that contain sub-ranges. And these sub-ranges contain sub-sub-ranges, and those sub-sub-ranges contain sub-sub-sub-ranges infinitely, basically, down to literally a 1 second chart, where there are still sub-sub-sub-sub-sub-sub-sub-ranges within your sub-sub-sub-sub-sub-ranges, within your, yeah, you get it, infinitely, until you've refined to a point where you cannot refine anymore, because the chart literally cannot go down that low past like a 1 second chart. You can use this as kind of a template to decide how you want to trade, what time frames, how long do you want to hold, what sessions are you going to trade in? Are you going to be holding for a few minutes, a few seconds, a few hours, a few days, a few weeks, a few months, a few years? Regardless, it all prints and happens the exact same. So you could use this in both investing and trading alike. That's why it's so powerful, among a ton of other things. But anyways, back to this real quick example. So here we have this overall range, and then you can see here this sub range within it as it prints. Now notice how as we have higher high, this higher high of this particular fractal, what does it do? It trades into this high volume area, accumulates, and goes. Here, yes, we had still failed to break above this high, but the sub-ranges of it follow the exact same parameters, where here, this pullback is trading into this high liquidity area for accumulating and heading higher. Here, we break up, we test back in, and we move to the top side. If you're using the concepts that were taught in the first section, you'll understand and see this pretty clearly already. So it shouldn't be too confusing, but I just wanted to make this quick video kind of explaining it. So we'll go from here. I'm going to show you this quick example. So remember, we have this overall range. Because price had failed to break here with momentum and close and volume above this high, this black line, we're now looking at the sub ranges of this overall move. That being this right here. Now, last thing I want to go over is the 4 stages of the market within a range. So, like I said, you're going to have your uptrend, your distribution, your downtrend, your accumulation, and then continuation back into an uptrend. This covers every single move in the market. Now, we just need to figure out a way to actually read it and actually apply these concepts. So, take this uptrend here, for example. That is going to be on a high time frame, just one range. So let's say, okay, here we have one range. Within that, what are the sub ranges of this overall range from this low here to this high? Would be this. Good. Simple. Now, what are the sub ranges within these ranges of this uptrend? Okay, what that would look like would be something like this. Now, take this low to this high, aka this first sub range within this uptrend of the overall range, and look at the sub range, or whatever you want to call it, of this. Notice here we have uptrend, distribution, downtrend, accumulation, and then a return to uptrend. All four stages of the market are present here the exact same way that they are present here. That's the main thing I want you to take from this video, is that we have ranges and sub-ranges, and that we apply these concepts moving left to right, reading the overall range, and then when we need to, aka whenever there's a failure to break or a reversal, we will read the sub-ranges of that given range. That's pretty simple. I hope it made sense, and in the next video I'll go more in depth with this and kind of explain it better. But yeah, this was just a pretty quick introduction to fractals and how they actually